Hi, everyone. We're just going to be talking about some of the common day-to-day items that you'll frequently see in an owner-managed corporation. Just to kind of go over our agenda, whoops. We'll be talking about investment assets, should you incorporate these or not. Some very common items, the meals and entertainment and golf. Obviously, everybody's got to eat, and a lot of people sure like to play golf. So very common items that CRA goes after. Automotive expenses, some CRA audit risks, some things to consider when you're paying yourself. A little bit more of a technical topic on association between corporations and how that impacts the bottom line for yourself, and a little reminder on installments. So investment properties. Often clients will come to us with a question, we have this or that asset, should we incorporate this or not? Frequently this will take the form in rental properties, particularly here in Vancouver, and marketable securities. The thing to remember is that you generally won't be getting those business tax rates, that 13.5% that you might be familiar with. The number is more like 45%. So there isn't really that immediate tax advantage to go and incorporate for investment properties. The other thing I wanted to talk about briefly was this concept of integration. It's sort of a tax principle where if you as an individual have an investment property, in theory you should be indifferent to owning that property as an individual or through a corporation once everything has flown out. That's the theory. In practice, it doesn't work quite so well. So to highlight this in the maximum tax bracket in BC, first for capital growth, you're slightly worse off in the corporation. You're looking at about 45.7% tax versus 43.8% in 2016. So you're losing about 2% there if you have your investment assets in a corporation. And relating back to the integration I just mentioned, you're looking at about 47.8% tax if all of that money that you earn in the corporation is flowed out to you, as opposed to, again, about 43.8% personally. So that's a 4% difference. It's not something to go and panic about. It does change on a fairly regular basis when governments put something new or fancy into the legislation. So this year it might be 4%, next year it might be 3%, and then the year after it might be 2% in the other direction. So it's not really something that you can plan for. The real benefit to having your investments in a corporation is to use it as a retirement or an income splitting vehicle. Presumably when you're retired, you'll be earning less money than you're earning now. The idea behind both of these is just that you're able to make use of those marginal tax brackets that might otherwise go unutilized. So when you're earning less money when you're retired, or if your spouse doesn't make the same level of income that you do, or your adult children don't make the same level of income that you do, it's a great way to go and save some money. Next, meals and entertainment. I'm sure everybody knows about 50% of that meal and entertainment cost is deductible for tax purposes. It's a very, very frequently reviewed topic item with CRA, just because, like I said earlier, everybody's got to eat, and everybody wants to go and put this through their corporation as much as possible. So some of the things that CRA is looking at is, do you have a receipt of this transaction? If you don't have a receipt, CRA is so happy to say that this never happened, or anything, just to make sure that you don't get a deduction for that. Now, it's not just enough to have that receipt, it's, do you have that receipt properly documented? Have you written on there who attended that lunch? If you don't, you might get a picky auditor that says, well, how do we know that this wasn't a business lunch or a personal lunch? The other item here is reasonability. If you're going and spending $30,000 on very fancy food and very, very fancy alcohol to go and wine and dine somebody for a $10,000 sale, that probably doesn't make sense. Obviously, it's an extreme example, but CRA can take whatever position that they like to say that this or that expense is not reasonable. The last point there is when the CRA reviews meals and entertainment, I found in my experience that the quality of that CRA review varies quite significantly from auditor to auditor. You might have some people that are extreme sticklers that will look at every receipt, make sure that every single one of them has a name attached to it. And you might have somebody that's a little bit more reasonable and says, well, you know, this type of expenditure makes particular sense in this business, so we'll let that pass. We'd like to recommend that you have your documents prepared for the stickler rather than the guy who's willing to go and let things pass. Last point here is that you do have exceptions for certain staff parties. All staff need to be invited to those staff parties. They don't all need to attend that staff party. Clients are also able to attend those, but there is a limit to 6 per calendar year. Golf. You might like to golf. The CRA does not like you golfing. Club dues, non-deductible. You got that fancy golf club set, non-deductible. Green fees, non-deductible. The only thing that you can really get away with is if you're at that golf and country club and you go out for a meal, you fall under the normal meals and entertainment rules that I described previously. Just as a side note, any sort of gym membership stuff, that also falls under that club dues, and they're non-deductible. Automobiles. You've worked hard. I mean, you're an owner, maybe an executive. That Mercedes-Benz AMG SL65, that's a nice car. You have to go for business lunches, right? You can't be expected to show up in some old beater when you get there, right? I mean, even your significant other approved of getting this nice fancy new car, sort of. Surely that's a business item. Yeah, let's put it in the corporation. Well, I'd caution to you to just slow down, think about it a little bit more. There might be some circumstances where that's appropriate, and there's a lot of circumstances where it's not. It's a very, very hot topic for CRA to look at auto expenses. The particular risk area is with passenger vehicles with mixed use. So those are your personal vehicles where they're being used partially for business purposes, partially for personal purposes. And the reason that they're very popular is that nobody keeps the primary evidence that CRA wants to see, which are mileage logs. So if you want to claim those auto expenses, make sure you keep a mileage log. But if you don't, there are some other ways that you can mitigate that risk. One is own multiple vehicles. If you have a $300,000 car and a $75,000 car, you're probably not going to be gallivanting around town in the $75,000 car. It makes a lot more sense that you would be using that one for business purposes. So it adds a little bit of credibility to the argument that that $75,000 car is used for business purposes. The other thing you can do is just reimburse yourself based on the kilometers that you actually drive. It's 55 cents, gets changed every year. And if you do it on that sort of basis, CRA is usually fine. Last point here, just to claim an accurate or a conservative amount of your vehicle expenses. If you're putting in that your vehicle is 100% business use, I would anticipate that you'll get a CRA audit. And just make sure that you have the backup to support that this vehicle is in fact used for 100% business purposes. The lower that percentage goes, the safer essentially you are from drawing the ire of the CRA. The last thing I wanted to talk about here was taxable benefits. So this only arises when a corporation owns a vehicle, so it won't really apply to any sole proprietors. So where there's a personal use component of a vehicle, that gets reported onto the T4 of the individual that actually uses that vehicle. And that could be an employee or it could be a shareholder. There are two components that go into this. One is called the standby charge, the other one's called the operating cost benefit. I won't get into the nitty gritty about how this is all calculated. It's a little bit complex, but for the standby charge, basically, it's a function of the cost of the vehicle, the period that you have it available, and by that I mean, have you used it for 12 of 12 months in the year or 10 of 12 months, and the personal components. So have you used this vehicle for 70% for personal purposes or 60% for personal purposes? As the cost of the car increases, your taxes go up. If you use the car for a larger period of time in the year, your taxes go up. If you use it more for personal purposes, your taxes go up. The operating cost benefit is a direct function of the number of kilometers that are driven for personal purposes. There's also some fancy stuff there with the standby charge, where if you use it more than 50% for business purposes, it can go down. But generally, that's what you're looking at for taxable benefits. These amounts can be small, but they also can be very large depending on the cost of the vehicle. That's just a really important thing to keep in mind when you're looking at putting an automobile in the corporation. And with that, I'll pass it off to my colleague Julia.
So I just want to wrap up with a few other miscellaneous items that we typically see when CRA comes knocking on people's doors. Every taxpayer needs to always keep in the back of your mind that CRA could come and audit you, and so you need to be prepared. We've talked about having good documentation. That's really important. And there's a few other particular expenses that CRA tends to focus on that I'd like to remind you about. Typically what will trigger an audit is large expenses, large deductions, claims for refunds. So GST returns, all of a sudden you have more input tax credits than taxes payable and you're requesting a refund. That will at least trigger a desk audit, if not a full-blown audit. I have a client right now who has wrote off a lot of invoices and he wants PST refund, so of course I have to send in all the documentation on that. So, be very careful when you're triggering any kind of a refund that it's legitimate and you can support it. A couple other things that John's already talked about, CRA's favorites, which are automobiles and meals. There's a few other ones I'd like to just remind you about, and one of those is legal fees. There are legal fees, there are different sections of the Income Tax Act and different rules depending on what the fees are incurred for. So we talked about, should you incorporate a company? Well, you're going to have a lawyer to do that for you. The costs to incorporate your company are deductible, but there's limits to that. It's 75% and it's amortized over the years. It's not a tax write-off up front. When we're going to be talking a little bit more about purchasing real estate, when you incur legal fees to purchase real estate, and also mortgage fees for arranging the mortgages, those expenses have to be written off or typically written off over a 5-year period. Legal fee, we've talked about buying the shares of another company, so you've bought the shares of this company, you've incurred professional fees to help you negotiate that. Those are going to become part of the cost of your shares. Legal fees for things like things indirectly related to your business, such as collecting money owed to you from clients, creditors, defending a legal action, trademark infringements, employment matters, dismissing an employee, those kind of things, those would be 100% deductible in the year that they're incurred. Another one that CRA will look at is insurance premiums. So the insurance that you have on your assets, your replacement of your assets, business interruption, that's all a perfectly legitimate business expense. Life insurance is a bit trickier. If your bank requires that you carry life insurance that's assigned to the bank and that's part of the terms of your borrowing agreement, then those premiums are 100% deductible, and CRA will want to see your banking agreement to verify that. Insurance, Premiums for things like disability or critical illness, those need to be paid by the individual person. And that's because if you ever are ill or disabled or need to claim those wage loss replacement or benefits, you need to have paid those premiums yourself in order for the benefits to be tax-free. So those you always want to pay yourself. Clients always ask us about, can I write off a portion of my home? You know, I check my emails in the evening from home, so I want to write off my home. It's very difficult to justify that as a business expense, especially if you have a place of business, you have an office that's available to you. We do usually put through a little bit of, you know, home internet costs and some cell phones. Cell phones, it's pretty easy to justify that as a business expense, but you need to be reasonable, you need to have documentation. You always need to be sure that that you can support your expenses, especially if you're paying things with credit card. Just giving CRA your visa statements is not adequate documentation. They're going to want to see the actual slips. If it's meals and entertainment, they're going to want to see written on it, you know, who did you take out. And if you want to claim the GST input tax credits, you need to have an invoice that has, you know, there was $4.50 of GST with this meal. I've actually seen CRA auditors that will go doing a GST audit, and they will go through your paid invoices, and they will check that the GST numbers on the bills are valid. And so when you're, just a couple of reminders, when you need to make sure that you have your GST number on your invoices that you give to your clients, and you don't necessarily always want to check on the CRA website if they're a valid number, but at least be sure that there is a number on an invoice if you're claiming an input tax credit. One of the things that we really like to encourage our clients to do is keep your record keeping simple. If you're using credit cards to pay things, get a company credit card that you use for business purposes. Use a different card for your personal stuff that nobody sees but yourself. You don't need CRA seeing that. And also, if you have staff, if you have employees that are paying your bills, you don't need to be showing, they don't need to see how much you've spent on your personal lifestyle. Just keep business separate from pleasure. We've talked a lot of different areas about salaries versus dividends. That's something that you need to evaluate based on your personal situation. Salaries are a good way of paying yourself when you are under 65, you want to contribute to CPP, and you want to be able to put money into an RSP, and you have childcare expenses that you want to be able to write off, because those can only be written off again. You have to have employment income to do that. Dividends are handy if you want to do income splitting. They don't have to be reasonable. They don't have to be, you can pay your spouse $100,000. It's fine. You always need to keep in mind when you have a company, the company is not your personal bank. You can't just take out all the money. If you take out all the money, we're going to have to do something. It's going to have to be a salary. It's going to have to be a dividend. We need to look at that every year. If you borrow money one year, it's got to be repaid. So in the accounting world, we always talk about having credit shareholders' loan balances. Any dividends or T4s, dividends are reported on T5s, salaries on T4s. These both have to be filed by February 28th. So for those clients that have December 31 year ends, it doesn't give us much time to do your tax planning, look at what you've taken out of your company during the year, figure out your salaries, figure out your dividends. So we always appreciate it when you're really timely getting your information together. And we talked about, I don't want to say a whole lot about small business deduction, but most of you know that active business income, the first $500,000 is taxed at the lower tax rate, 13.5%. There are some situations where we have capital intensive companies or companies with a large amount of debt where small business deduction isn't available, but you'll need to, we'll be telling you if that happens in your business. And again, we also wanted to talk about related companies. So the $500,000 small business deduction is really nice, but you can't create 10 companies to do this. So there are rules around control, and control can also mean is voting shares as well as mind and management of the business. So you need to keep that in mind and plan for how to divvy up your small business deduction and make sure that you take advantage of that. And it's getting late and people are getting tired, so I'm going to wrap it up with one last thing. And Bill Davidson, who couldn't be here, specifically asked me to remind everybody about making your installment payments. So CRA wants your money and they want it sooner rather than later. So everybody has to make some kind of installment payments. So if you're on salary, you're going to make those through payroll remittance. You're going to make them monthly, which is really nice. That makes cash flow easier. If you're a small company and you only pay yourself a bonus annually, you'll send in your deductions at source once a year. There are all kinds of different rules around how fast you have to remit your deductions at source, and it's based on your average remittance during the year. So if you pay yourself an annual bonus, your remittance period is 1. Your average is 1. So if you have a big bonus and a big remittance, there are accelerated deadlines as to when you have to pay that, and you'll need to talk to us to find out when those are. Quarterly, if you have if you get your income from your company by way of dividends, the company, there's no payroll remittances on dividends, but you as an individual receiving those dividends have to be making your quarterly personal tax installments. And those are due on the 15th day of March, June, September, and December. So that's important to keep those in mind. Corporations have to pay income tax installments monthly, usually monthly, and it's based on your previous year's income. And if you're a GST annual filer, you need to make quarterly installments based on your estimated GST payable for the year as well. And the big CRA will charge you interest for insufficient or late installments, and the rate is currently 5%, which is more than the bank borrowing rate. And CRA interest and penalties is not tax deductible, so there's no advantage to paying that interest to CRA if you can help it. When we do your taxes, whether it's a personal or a corporate, we will always give you an installment schedule. It'll come with your personal tax return if we do your tax returns, and if we do your corporate returns, we'll give you an installment schedule with that as well. If you really know for sure that your current situation, your taxes are going to be significantly less than the prior year, you can choose to make a lower installments, but if you guess wrong and you end up owing tax, you will end up getting the penalties. So you want to keep those installments up to date and current. And that's all I wanted to say.